The foundational principles of Richard Wyckoff provide a robust basis for uncovering these crucial signals. At the core of his philosophy lies the law of supply and demand, which dictates all price action. This fundamental law explains how the imbalance between buying and selling pressure is the primary driving force behind every market movement, serving as a key hidden signal. When demand unequivocally surpasses supply, prices will invariably rise, reflecting an eager appetite for the asset. Conversely, when supply overwhelms demand, prices are destined to fall, indicating a prevailing desire to sell. During periods of relative balance between these forces, the market tends to consolidate, moving sideways as it seeks equilibrium. Building upon this, the law of cause and effect elucidates that every significant market movement possesses an underlying cause. This cause manifests itself in distinct phases of accumulation or distribution, which then create a subsequent effect in the form of an upward or downward trend. A prolonged period of accumulation where smart money systematically buys up assets serves as the fundamental cause for a subsequent bullish trend. Conversely, an extended phase of distribution, where large players offload their holdings, inevitably leads to a bearish trend. Understanding this relationship allows for a deeper appreciation of market structure. Finally, the law of effort versus result introduces the critical role of trading volume in confirming price movements. Volume represents the effort exerted by market participants, which must be commensurate with the result observed in price action. A harmonious relationship exists when price increases on high volume, confirming the strength and validity of an uptrend. Similarly, a price decrease on high volume validates a downtrend. Discrepancies such as price rising or falling on low volume act as powerful warnings. These divergences can signal a potential reversal or a significant weakening of the current trend, indicating a lack of conviction behind the price movement. The market phases outlined by Richard Wyckoff provide a structured framework for identifying these hidden signals. He conceptualized the market as moving through four primary cycles: accumulation, an upward trend, markup, distribution, and a downward trend, markdown. This cyclical nature is fundamental to his analytical approach, offering a roadmap for anticipating shifts in market direction. Central to this understanding is the concept of the composite man, an imagined entity representing the collective actions of large, sophisticated institutional players. This composite man strategically manipulates the market, creating the very hidden signals that smaller, less informed traders must learn to decipher. During the accumulation phase, the composite man systematically acquires assets at lower prices, often during periods of pessimism or fear. Conversely, during the distribution phase, this powerful entity strategically sells off its holdings, capitalizing on periods of optimism and rising prices. Recognizing these deliberate actions is paramount for aligning one's trading decisions with the dominant forces in the market. The composite man's activities are not random. They are calculated moves designed to profit from the predictable behavior of the crowd. Learning to think like the composite man is key to unlocking Wyckoff's insights. Let us now delve into the specifics of identifying hidden signals within the accumulation phase, which invariably precedes inevitable upward market moves. This phase is meticulously structured into several subphases and events. Phase A marks the end of the previous downtrend, characterized by a series of critical events. The first sign is often the preliminary support, where initial buying interest begins to emerge, slowing the pace of the price decline. This indicates that sellers are starting to lose their grip on the market, even if only temporarily. Following this, a dramatic event known as the selling climax typically occurs. This is a moment of panic selling, often accompanied by extremely high trading volumes, where a large number of participants capitulate and exit their positions in despair. The selling climax effectively washes out the remaining weak sellers, creating a base for future upward movement. Immediately after the selling climax, an automatic rally ensues, characterized by a sharp, rapid rebound in price. This rally forms the upper boundary of the developing trading range, as demand temporarily overwhelms the exhausted supply. The market then experiences a secondary test, where the price declines again, retesting the area of the selling climax. Crucially, this test occurs with significantly lower volumes and reduced volatility compared to the selling climax itself. This reduction in selling pressure confirms that the supply that caused the initial panic has largely been absorbed, indicating an exhaustion of sellers. These initial events in Phase A are crucial for recognizing the very first hints of an impending shift in market sentiment. Phase B represents the period of consolidation, where the composite man actively builds a substantial long position. During this phase, the market typically moves sideways within a defined trading range, with price testing various levels of resistance and support. The composite man strategically accumulates assets, absorbing all available supply without driving prices too high. This prolonged period of sideways movement is essential for establishing a strong cause for the subsequent upward effect. Traders observe multiple waves of buying and selling, each contributing to the overall accumulation process. Phase C is a pivotal stage, often featuring a decisive test of the previous low. A key event here is the spring, a powerful hidden signal of future growth. A spring involves a false breakout below the established support level of the trading range, designed to shake out the last remaining weak sellers. Price quickly snaps back into the range, trapping those who sold at the low. This maneuver confirms that the composite man has successfully absorbed almost all available supply and is ready to initiate the markup. After a spring, the market often undergoes a test of the spring. This is a re-evaluation of the level where the spring occurred, checking for any lingering supply. If the test shows low volume and an inability for sellers to push prices significantly lower, it further confirms the market's readiness for an upward move. Another event, the shakeout, can also occur in Phase C or D. A shakeout is a sharp, sudden drop in price intended to dislodge any remaining retail traders before the main trend begins. It's a final clearing of the decks, paving the way for the inevitable upward movement. Phase D provides confirmation of the new trend, signifying that the market is ready to break free from the accumulation range. A critical event in this phase is the sign of strength. This is typically a decisive break above the resistance level of the trading range, accompanied by significant trading volumes. The sign of strength clearly demonstrates the dominance of demand over supply, unequivocally confirming the market's readiness for a sustained upward movement. This breakout is a powerful visual cue that the composite man has finished accumulating. Following a sign of strength, the market often experiences last point of support events. These are corrections or pullbacks that occur after the breakout, but crucially, they hold at higher levels within the new trend. These pullbacks demonstrate that the previous resistance has now become support, reinforcing the strength of the emerging uptrend. The last point of support is an ideal entry point for traders who missed the initial breakout. Finally, Phase E marks the beginning of the sustained upward trend where price consistently moves higher, breaking out of the accumulation range and entering a markup phase. As we navigate these complex market structures, it's invaluable to connect the dots between historical market behavior and current trading opportunities. Understanding the strategies and principles of legendary figures like Richard Wyckoff can be greatly enhanced by exploring the broader context of financial markets. This is where resources like Trading Insights and Wall Street Memoirs become incredibly useful. Trading Insights offers a deep dive into the specific strategies, methods, and guiding principles of accomplished traders, speculators, and investors, providing concrete examples of how theories like Wyckoff's are applied in practice. It allows you to see the real-world application of the concepts we are discussing, turning abstract ideas into actionable knowledge. Coupled with this, Wall Street Memoirs provides a fascinating journey through historical events, pivotal financial crises, and the lives of the most influential figures on Wall Street. By understanding the historical backdrop, the evolution of market mechanisms, and the enduring human psychology behind financial decisions, you gain a richer perspective that complements technical analysis. Knowing how past crises unfolded and how market titans navigated them equips you with a deeper appreciation for the cyclical nature of markets and the timeless wisdom of strategies like Wyckoff's. These channels offer a comprehensive educational experience that bridges theory with practical application and historical context. Make sure to subscribe to Trading Insights and Wall Street Memoirs to enrich your understanding of the financial world and sharpen your analytical skills. Now let us turn our attention to identifying hidden signals within the distribution phase, which precedes inevitable downward market moves. Just like accumulation, distribution is a structured process designed by the composite man to offload assets at advantageous prices. Phase A signals the end of the previous uptrend, much like its counterpart in accumulation. The first warning sign is often the preliminary supply, where initial selling interest emerges, slowing the upward momentum of the price. This indicates that buyers are beginning to face resistance and the market is losing its upward thrust. Following this, a buying climax typically occurs. This is a moment of frantic buying, usually characterized by extremely high trading volumes, where a large number of participants eagerly enter the market, driven by optimism. The buying climax signifies the exhaustion of demand, as the composite man uses this surge to offload a significant portion of his holdings. Immediately after the buying climax, an automatic reaction takes place, a sharp and rapid decline in price. This reaction forms the lower boundary of the developing trading range, as supply temporarily overwhelms the exhausted demand. The market then undergoes a secondary test, where the price attempts to rally again, retesting the area of the buying climax. Crucially, this test occurs with significantly lower volumes, indicating a clear reduction in buying pressure. This confirms that the demand that caused the initial buying frenzy has largely been satisfied, signaling an exhaustion of buyers. These initial events in Phase A are vital for recognizing the first hints of an impending shift from bullish to bearish sentiment. Phase B is the period of consolidation where the composite man actively distributes his long positions. During this phase, the market typically moves sideways within a defined trading range, with price testing various levels of resistance and support. The composite man systematically sells off assets, absorbing all available demand without driving prices too low. This prolonged period of sideways movement is essential for establishing a strong cause for the subsequent downward effect. Traders observe multiple waves of buying and selling, each contributing to the overall distribution process. Phase C is a critical stage, often featuring a decisive test of the previous high. A key event here is the upthrust, a powerful hidden signal of future decline. An upthrust involves a false breakout above the established resistance level of the trading range, designed to trap the last remaining weak buyers. Price quickly snaps back into the range, leaving those who bought at the high in a losing position. This maneuver confirms that the composite man has successfully distributed almost all available assets and is ready to initiate the markdown. After an upthrust, the market may undergo a test of the upthrust. This is a re-evaluation of the level where the upthrust occurred, checking for any lingering demand. If the test shows low volume and an inability for buyers to push prices significantly higher, it further confirms the market's readiness for a downward move. Another variant, the upthrust after distribution, is similar to a standard upthrust, but occurs after a significant portion of the distribution has already taken place. This signals the imminent start of a major downward movement, serving as a final warning to those still holding long positions. Phase D provides confirmation of the new trend, signifying that the market is ready to break free from the distribution range. A critical event in this phase is the sign of weakness. This is typically a decisive break below the support level of the trading range, accompanied by significant trading volumes. The sign of weakness clearly demonstrates the dominance of supply over demand, unequivocally confirming the market's readiness for a sustained downward movement. This breakdown is a powerful visual cue that the composite man has finished distributing. Following a sign of weakness, the market often experiences last point of supply events. These are rallies or pullbacks that occur after the breakdown, but crucially they fail to reclaim higher levels within the new trend. These rallies demonstrate that the previous support has now become resistance, reinforcing the strength of the emerging downtrend. The last point of supply is an ideal entry point for traders looking to initiate short positions. Finally, Phase E marks the beginning of the sustained downward trend, where price consistently moves lower, breaking out of the distribution range and entering a markdown phase. The role of volume in decoding these hidden signals cannot be overstated. It is the lifeblood of Wyckoff analysis. Volume acts as a barometer of market sentiment and the underlying intentions of the composite man. Detailed consideration of how volume anomalies, such as rising volume on a falling price or falling volume on a rising price, are crucial indicators of hidden intentions is essential. These divergences between price and volume provide invaluable clues that simple price action alone cannot reveal. For instance, high volume accompanying a selling climax or a buying climax is expected, as it represents the peak of emotional capitulation or euphoria. Conversely, low volume during secondary tests, whether in accumulation or distribution, is a key confirmation. It indicates that the opposing pressure, sellers in accumulation, buyers in distribution, has largely been exhausted, paving the way for the composite man's intended move. When price breaks through significant resistance or support levels, a surge in volume is imperative. This confirms the validity of the breakout and signals strong institutional participation, indicating a genuine shift in market control. Without this volume confirmation, a breakout might merely be a false move designed to trap unsuspecting traders. Interpreting volume correctly requires nuance. A rising price on decreasing volume suggests that the buying pressure is weakening, potentially signaling an impending reversal. Similarly, a falling price on decreasing volume indicates that selling pressure is diminishing, hinting at a possible bounce or accumulation. The absence of volume confirmation on a breakout is a red flag, often leading to failed moves. Wyckoff's method teaches us to view volume not just as a number, but as an expression of effort that must align with the observed price result. Integrating all these signals is crucial for forecasting inevitable market moves effectively. A comprehensive approach involves combining all elements of Richard Wyckoff's strategy: his fundamental laws, the distinct market phases, the specific events within those phases, and the critical role of volume. This holistic perspective allows traders to construct a complete and coherent picture of market activity, moving beyond isolated indicators to understand the underlying narrative. By meticulously observing and interpreting these interwoven components, one can anticipate the market's next significant move with greater precision. The ultimate goal of this integration is the identification of optimal entry and exit points. The hidden signals discussed, such as a spring in accumulation or an upthrust in distribution, confirmed by volume, serve as powerful indicators for initiating positions. For example, entering a long position after a confirmed spring and its test, or taking a short position following a clear upthrust, aligns one's trades with the composite man's actions. Similarly, signs of weakness after distribution or signs of strength after accumulation provide clear signals for closing opposing positions or initiating new ones in the direction of the anticipated trend. Furthermore, Wyckoff's principles enable the forecasting of the scale of the movement. By applying the law of cause and effect, traders can estimate the potential size of a future price movement based on the duration and intensity of the preceding accumulation or distribution phase. A longer, more extensive accumulation phase implies a larger, more sustained upward trend, as the composite man has built a significant position. Conversely, a protracted distribution phase suggests a substantial downward trend. This foresight allows for better risk management and position sizing, aligning expectations with market reality. In conclusion, Richard Wyckoff's strategy transcends a mere collection of technical tools. It represents a profound philosophy for understanding the market through the lens of smart money actions. It provides a systematic framework for deciphering the otherwise opaque movements of large institutional players, allowing individual traders to anticipate significant shifts. This method demands discipline, observation, and a willingness to think critically about market behavior. It's about more than just looking at charts. It's about understanding the psychology and mechanics of supply and demand. The enduring power of Wyckoff's approach lies in its ability to uncover hidden signals that precede inevitable moves on financial markets. Mastering this strategy requires continuous learning, diligent practice, and the development of a keen eye for detail. By consistently applying his principles, traders and investors can significantly enhance their ability to navigate the complexities of the market, making more informed decisions and ultimately improving their trading outcomes. Embrace this timeless methodology, and you will gain a deeper, more profound appreciation for the intricate dance between price and volume. For those eager to deepen their understanding and truly master these invaluable techniques, an exceptional resource awaits. Richard Wyckoff's seminal work, How I Trade and Invest in Stocks and Bonds, is now available in an adapted edition. This classic treatise meticulously unveils his time-tested methods for analyzing market behavior, deciphering the true intentions of major players, and making well-informed trading decisions. It's an indispensable guide for anyone serious about applying the principles we've discussed today, offering direct insights from the master himself. Discover the intricate details of his approach and transform your market perspective. You can find the link to this essential read in the description below the video.